So I've been wanting to do a series on COVID-19 economics. I've seen a lot of reports where it's been talked about like it's worse than the Great Depression or it's worse than the 2008 financial crash. And I wanted to show how it's really a different thing to that. Whether it ends up in a big depression, it really depends a lot on how the government reacts to it. And so I wanted to make some videos showing why that is. So in this video I'm going to talk about stimulus and tax and how they work and why it's so important that we tax from the correct place in society after the crisis is over. I also want to show why a deeper understanding of how tax works is so important for society and why the way it appears causes so many problems politically. And later in the series I'm going to talk about rents, since rents don't decrease now even when all the other costs do. And I'll also make a comparison between different potential policy options, so hopefully using some real input-output table data from the Office of National Statistics. But I'm really quite busy right now working through things for other people, so it's going to take me a while to complete. So if you're interested in following along, just maybe subscribe and hit the bell icon, and then it will inform you when I upload another video. So in a broader sense, I want to talk in this series also about how we might move towards a more democratic macroeconomy. So I've just got funding for PhD for this, so I'm super happy right now. I've just got 3 years to work on what I want to work on and develop a mechanism for the democratic macroeconomy. So I'll start to talk about a little bit about how that might be possible as well. So I'm going to give a brief overview of how input-output tables work before I start. So if you've already watched the Strapper videos or the other videos that I've done, feel free to just skip forward a few minutes, because otherwise you're going to be bored. So this here is an input-output table, and it's a model of a very small economy. So there's 3 products as it is right now. There's an iron industry, there's a wheat industry, and there's a pig industry. And the iron industry, it's representing the capital of the economy. The wheat industry is representing subsistence products for workers. It's what they buy with their wages. And the pigs is representing the capitalist surplus product. It's what they buy with their profit. So it's not including here using profit for accumulation of capital. It's just very simple. Capitalists just spend their money, and capitalists only spend on pigs, workers only spend on wheat. So it's all very clear and distinct. So down the columns just here we have the inputs to each industry. So for the iron industry, for example, they're using £6 worth of iron to make their product. They're using £9 worth of wheat in terms of wages for their workers, and they're also going to consume pigs, £6 worth of pigs as their profit. And this might seem a little bit strange because the profit isn't usually seen as an input to production, but on this model that's how we're treating it. So you can say that up to this line here is going to be the material costs of production. So below this line is the material costs, and above this line is going to be the profits. Then across the columns we have the outputs from each industry to all of the other industries. So for example, the wheat industry, here they're outputting £9 of wheat to the iron industry, and as you've just seen, that's the workers' wages in that industry. They're gonna buy wheat with it. And then for the wheat industry, they're using £24 worth of wheat as wages for their workers, and their pig industry is using £12 worth of wheat in the end. So as you can see, all of the inputs are also outputs. So, and for this reason, at the end, when you total up all of these columns, so here £6 plus £9 plus £15 is £30. Here it's £45, and here is £21, and down the columns, 6 plus 9 plus 6 is again £21, so £21 and £21. £45, which is the same as the outputs, and in the pig industry £30. So all of the inputs and the outputs of the table have to always total each other. This isn't some kind of economic equilibrium, it's like an analytical truth, because the buying costs and the selling costs are the same. You can't sell something at a different price than somebody buys from. So you end up with this very nice structure where you can see both the income and the costs of all the industries. So this here is the income of the pig industry, £30, because they're going to sell to all of these industries these amounts. And down here, this is the cost of the industry. So the costs, they're going to spend £3 on iron, they're going to spend £12 on wheat, and they're going to spend £15 on pigs. And this particular cost is considered as a profit. So now we're going to add another sector to this economy. There's going to be a government, they're going to provide a hospital, and they're going to do it using Keynesian stimulus, which means that they're just going to print the money essentially to make this hospital work. And so just to make the math easier on this, I'm just going to assume that the hospital costs are going to be half as much again as what was already being produced. So here the iron output was £21. I'm going to assume that the hospital is going to add an extra £10.50 to that. And here £45, so an extra £22.50 to that. And I guess hospitals are not really for profit, so they shouldn't really be getting any pigs. But I'm just going to say that the managers of the hospital are going to get some pigs anyway, because that's the kind of society that we're in. So I'm going to say that they're going to get 1/10 of them. 1/10 as much again, so £3. And now because the outputs have increased, so here it's increased by £22.50, so this is going to now be £67.50. The cost of making those outputs are also going to go up. You're going to need more wages for your workers, and you're probably going to need more iron to make that extra wheat. So if we just again make it easy and assume that it's going to go up in the same proportions as before, so half as much again. So that's £36. This will be £18. It'll be the same in the iron department. So here it will be £9 plus £4.50 is £13.50, and £6 plus £3 is £9. And in the pig department, again, it was 1/10. So here this is going to be £3.30, adding on an extra 1/10 in production costs, and here we add on £1.20, so that's £13.20. Okay, so now if we total up everything that's going on along these rows and columns, so the new output of the pig sector is going to be £33. The new output of the wheat sector is going to be £13.50 plus 36 plus £13.20 plus £22.50, that's £85.20. And the new output of the iron industry is 9 plus 18 plus £3.30 plus £10.50, so that's £40.80. And the new costs of the iron industry are 6 plus 13.50 plus £9. So that's now £28.50. The new cost of the wheat is 9 plus 36 plus 18.63. And of the pigs is 15 plus 13.20 plus 3.30, so that's £31.50. And now so we can see that the total income of the pig industry is £33 and the total cost of £31.50. We know that they're going to have an extra £1.50 profit on top of this. And for the wheat industry, the total income just here is £85.20, and then the total cost is £63, so they're going to have an extra £22.20 worth of profit. And the iron industry, they're going to have £40.80 worth of income and £28.50 of costs, so then they're gonna have an extra £12.30 profit at the end. So there's a few really important things to notice here, and the first is that even though the costs of all of these other sectors have increased, it hasn't had any effect whatsoever on the amount of luxury products that the capitalists can buy. This row has not changed at all. So they're still, the iron industry, they're still going to get their £6 worth of pigs, and the wheat industry are going to get their £9 worth of pigs, and so on. The second thing to notice is that, again, despite the fact that all of these costs around here have risen, the aggregate profit has actually risen by exactly the same amount as the hospital sector's input. So if we add this row and column up, this is equal to £36, and down the column as well, this is equal to £36. So even though, for instance, there's a higher wheat cost of producing this wheat for the hospital, you're still going to get £36 worth of profit added on, which is the same as the costs to the hospital. So although kind of intuitively we might think that increasing these costs just here might decrease the profit, this just isn't the case when you're adding another sector to society that has costs of its own. So every increase in costs below this line is also an increase in income. And since the costs of this new sector it always appears again as income in the other industries, no matter how much their own costs rise, you're going to end up with this extra profit on the top. And I know this might seem a bit counterintuitive at first, but it's a really important point in understanding the essence of the tax system. So ideally, technologically, we would be able to track the money as it's spent out from the hospital sector, find out where it's going to end up in society, and then you just tax that money back and give it back to the hospital sector. It's a little bit complicated because of the structure of the economy. It doesn't end up exactly as much as the hospital has paid into each sector. So the £10.50 that is paid into the iron sector, actually it ends up as £12.30 worth of profit. And here in the pig sector, they paid £3 into the pig sector, but there was only £1.50 profit in the end in that sector. So it's going to end up a little bit more complicated to know how this matrix is really squashed in society itself empirically. So obviously the assumption that is being made here is that the material conditions of production are malleable, so production can easily increase in iron, wheat and pigs. And if they can't, that's going to be a problem. And at the micro level, there's many reasons why this might not be the case. So businesses might not be able to get loans, even though if they did, they would have been able to get this extra money in. And so they would have a cash flow problem and not be able to increase production. And that hints at why the way that we've been considering money is, in a lot of cases, quite nonsensical. But I won't go into detail on that. The issue with the hospital sector and with government sectors in general is that, so in the other sectors, the money it automatically flows back to them. So if you're making pigs, you're going to spend the money out, and then other people are going to buy your pigs, and you're going to get back your profit and costs. But with the hospital sector, because it's ending up in businesses, and businesses are not necessarily tied to who needs the hospitals in any one period, and in fact, mostly people who need the hospitals can't work because they're retired or because they're too ill to work. So it doesn't make it an easy flow back to the hospital. So if you could just track it, then it would make it so much easier to just tax it back. And as it's been shown here, it doesn't affect the amount of luxury consumption that the capitalist has at all. But now it becomes very clear that tax is not an economic problem, it's a political problem. So it's about the way that the money appears to be owned by the capitalists. So the moment that the money that's come from the hospital sector appears again in these industries, it's appeared as if it's owned by the capitalists. And now it seems like you're taking something away from them when you're taking it back. So of course this can create huge problems politically. Of course this is just a completely made up example with just arbitrary numbers. But for instance here, the wheat sector, these capitalists would be saying, hold on, now you're taxing 2/3 of my profit away. And that is going to be completely politically impossible in many countries. But the fact that it appears like this, it's just a mirage. Like, if the hospital didn't exist, so if this sector didn't exist, this extra money just here wouldn't exist either. And it certainly wouldn't be coming as profit to the capitalists. So it's important to be able to say, like, look, this is where the money is coming from. It's not just appearing because the capitalist has done a really good job. It's appearing because we needed a hospital and we funded the hospital just here. But because it appears socially as if the capitalists own this money because they've got it as profit in their company, they believe that they should have the right to spend it again. And of course they're not going to spend it on the hospital by themselves because they're not the ones who are using the hospital. So instead they're going to spend it on the luxury sector. So the production of pigs is going to increase, and when that increases, that's going to create a problem for the hospital because the hospital is not getting the money back. And this is the perennial problem of tax, where there's a constant struggle between spending on capitalist individual consumption of luxury products and spending on social provisioning. So this extra money that's come from funding public projects, it ends up in the luxury sector, and then the governments have to borrow more money in order to fund the hospital again. Or, as we've seen during austerity, they cut the social provisioning altogether because they say that they can't afford it. And so then not only do we see a drop in the quality of some of the most important services like healthcare, but we also see a rise in poverty, as the poorest in society, they often have their services cut and their welfare payments crushed to the absolute minimum. And this is a direct consequence of the money that has in the first place come from the funding of social projects being mistaken for profit and ending up in this luxury sector. And I really want to impress how important this understanding is for society and how important this is going to be in the wake of the coronavirus crisis. Because I hope you can see from this why that kind of policy is completely unnecessary and harmful. So I also hope you can see why economically, if we need a project funding, we should just fund it. And as a side point, this is absolutely why we should be pursuing a Green New Deal using Keynesian stimulus right now also. So the crucial points for using Keynesian stimulus is whether the material output of the other industries can rise to meet the extra demand, and whether we can tax the money back from the right place. If either of those conditions aren't met, we can get big issues with inflation or secondary effects on the economy. I'm not going to go into detail of that here, but it is important. So I think we absolutely need a mechanism by which we can track where the stimulus is ending up and tax it back. And if we don't do that, we're going to see another rise in inequality and austerity as a consequence of any stimulus given during the coronavirus crisis. So moving towards a more democratic economic system, if we had the technological means of tracking where this money ends up, we could sort of democratically elect it as a social cost. So instead of it appearing on the profit side, it would be seen as a social cost in here. And then we could prevent it from being seen as profit at all. So that's part of what I'm going to be working on these next years, sort of the mechanism for how we can democratically elect social costs, and also a mechanism of how to prevent it from being seen as profit. And then at the micro level, we could also potentially decide a reward for organisations that provide particularly good services under a separate mechanism from the usual one, so that we don't end up with this direct trade-off between the luxury sector and social provisioning. Now obviously with Covid-19, we're not adding on a sector like we did here. Instead, we're removing a sector, but I wanted to show how stimulus works first, and then I'll show what the potential policy options are later. So I hope you're all healthy and everybody you know is as well, and stay safe, and as always, feel free to ask any questions if I've been unclear anywhere.